We're live on YouTube. Fantastic.
Yeah, I didn't know that. That's great.
Become YouTube influencers.
Oh, wow.
Hashtag Jim Costello.
Hey, it's no time to run your publicity there.
We're up to 60, guys. So coming up.
That's going to be fun.
Okay, we'll start now. Hello, everyone. On behalf of the counselors of real estate, it is a distinct privilege to welcome you to this session of What's Next for Real Estate and the Life Experience, Trends Driving Commercial Real Estate Markets. Thank you for joining us. I'm Michel Couillard, 2021 Global Chair of the Counselors of Real Estate and President and CEO of Buzac Real Estate and Equities in Montreal, Canada. The Counselors of Real Estate is a distinguished international group of accomplished leaders solving complex real estate challenges, experienced, innovative, and credentialed problem solvers. Counselors practice in 20 countries and offer expertise in more than 50 real estate disciplines across all asset types and classes. Each has earned the prestigious CRE designation. This webinar series represents the very essence of the compelling thought leadership for which the Counselors of Real Estate is known. We'd like to offer you a complimentary subscription to our peer-reviewed professional journal, Real Estate Issues, by visiting cre.org/publications with an S. And to learn more about the Counselors of Real Estate and its 1,000 CRE credentialed professionals, please visit cre.org. That's cre.org. I'd like to recognize our sponsors for the What's Next webinar series, the Altus Group, Equus Capital Partners, and Real Capital Analytics. Thank you, as always, for your support. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcome, and we'll answer as many questions as time allows. So today, we're very fortunate to hear from the founder and president of Real Capital Analytics, Robert M. White Jr., CRE, as well as Real Capital Analytics Senior Vice President James M. Costello III, also CRE. The firm has widely been credited with pioneering research and fostering market transparency to better quantify property prices, liquidity, and capital flows. Moderating today's special presentation is from Canada's Central Bank, Bank of Canada's Mario Lefebvre, CRE, whose witty yet penetrating style is one you'll enjoy. Welcome, Mario. It's a pleasure to have you moderating this.
Thank you very much, Michelle. Thanks for asking me to moderate this session. It's not my first, so I guess people are not yet bored with my thick accent. So I'll try today to challenge my friends Bob and Jim. I'll first let them go. Jim's going to run a presentation just to set the table. And once we're going to have that done for about 15 minutes or so, I'm going to jump in. Bob is going to join Jim and I. We're going to go for another 15, 20. I know how you participants like to be heard. Ask your question. There will be time. I promise you that. By I'd say 1:35 at the latest, 1:40 Eastern time, we're going to pass the microphone on to you, participants, and you can definitely ask your question to both Jim and Bob. So, without any further ado, I'll first let Jim give his presentation, and then I'll challenge him on it, and he will need the help of Bob. Trust me on that. All right, Jim, take it away.
Great. Thank you, Mario. And your accent isn't too outrageous. I used to work with Ray Torto in Boston, and that guy, talk about a thick accent. Yeah, we wanted, I know that most of the folks here are in North America, spread between the United States and Canada. But I wanted to start with a big global picture on what's happening with investment activity. We've had, we had a drop in deal volume in response to the COVID crisis. That's not surprising. Looking here at sort of income producing property only, kind of getting rid of the development site sales. Q1, it was down 24% year over year. The drop, though, for Q1 was better than what we saw in the middle of 2020, where it was down 45% year over year in a couple quarters. So it's like that pace of decline is moderating. In some sense, I feel like the Q1 data is going to be the last point when we see that big decline, because we don't have that continual quarter after quarter after quarter decline that we saw in the aftermath of the financial crisis, where it took like 2 years for the market to find a bottom. We were down for a little bit, and it's not like climbing generally, but we're not seeing that big erosion anymore. So it's kind of reflected in prices. Prices. Except for the Asia Pacific countries, we didn't see a massive decline in prices throughout the crisis. Looking here at the RCA Commercial Property Price Index, and we build an index on transaction prices looking at same store concept, sort of one building today versus where it sold last, and kind of stringing that all together statistically. We see that the Asia Pacific region was really the only one that had a major decline, but it even started before COVID. Some of it had nothing to do with COVID. That's an important point that I think people need to be thinking about real estate broadly. There's a lot that was happening in the world before COVID hit. And everything nowadays, COVID just sucks up all the oxygen in the room for analysis and thinking about property values. But there were challenges and opportunities that were underway well before COVID hit that you need to start thinking about again, because COVID is starting to fade in some cases. But nonetheless, deal volume and pricing did not respond like it did in the financial crisis. Globally, prices continued a bit, and volume didn't go through 2-3 years of decline. This downturn was different. It was a shock to the fundamentals of tenant demand, but a temporary shock, as opposed to a collapse of the capital stack. So the full response of pricing and deal activity should be different. So now I'm going to dial back to just the United States, and I feel kind of bad in this presentation, just the timing. I'm talking about everything Q1, and we're just days away from looking at our Q2 figures. So and I'd use the Q2 figures with this group, except they're not finished. There's still a lot of rough edges that need to be polished. And I feel bad talking about it in the sense that this is kind of like the last time I'm talking about everything being down. On a year-over-year basis, deal volume in the first quarter was still bad for every sector, because we were still facing those challenges of the pandemic and the reduction of activity that came from the pandemic, across all property sectors, even industrial, which everybody and their brother wants to own a logistics facility at this point, but even the industrial sector was down in the first quarter. Part of it was because of some outsized deals from Prologis in Q1 of 2020. And just making those comparisons was kind of a challenge. But nonetheless, it didn't matter. Industrial was still down, even when you strip out those big purchases, multi-billion-dollar purchases by Prologis. It was down because when everybody's stuck on their couch, you can't get out and get deals done very easily. So activity was still down for a while. We were starting to see a little bit of a breakdown where there was a lot of talk early on in the downturn about, nobody wants to be in the cities anymore, the big expensive coastal markets. Businesses are going to leave and everyone's going to move to Florida and Texas. And, the deal volume was starting a little bit in the first quarter to reflect that, down a little bit more in the 6 major metros than the rest of the country. But I think some of that story of folks kind of moving away from that was at times maybe just a little bit overblown. Nonetheless, I think this is probably the last point when we have a slide like this showing everything down consistently. So with everything down consistently, it's recovering a bit. Investors are hungry for yield. That's one thing that's different today. Investors, there's still a ton of capital. It's a very liquid market for investment. Folks are looking for any kind of activity, and that's leading to much more of investor interest in alternative real estate sectors. We're getting inundated with questions from folks about things like medical office, student housing, data centers, life sciences, especially in the aftermath of the COVID crisis. Everybody understands, hey, there's a lot of technology and growth that's coming in the medical technology sector. If I own the real estate around that, that's a way to capture some of those gains. So we've seen tremendous growth in interest in these alternative real estate sectors. Same time, it's a challenge because some of these are thin markets. I mean, the self-storage sector, only 1.4 billion in deal volume for Q1. Between friends, $1 billion is a lot of money, but for a market for investors, that's still sort of a thin market. And that creates a challenge at times because, with fewer observations, a less thin market, valuing assets can be more problematic because you just have a wider dispersion of prices. But one thing that has not really come through from all of the challenges of the pandemic is distress activity. This is something that in this crisis that I've seen a lot of folks doing the same thing that I've seen in the last few downturns, where people look at the last bad event that they went through and think that, hey, it's going to happen again, so I better get ready for that. And so what I mean by that is, people are using the same playbook that they saw someone be successful with in the last downturn. They knew somebody who bought some distressed debt and gained control of the property and made a lot of money. And so the thought is, I can do the same thing this time since we're in a recession. But we're just not seeing a lot of distressed asset sales at this point. I'm looking here at the distressed sales in orange and the percent of the total market in blue. Part of it is that last time it took 18 months for the market to really start seeing distressed sales as a percent of total start to spike. We're only 14 months in. So one might argue that we're due, that it just hasn't happened yet. But fundamentally, I just don't feel that it's the same because you had a different situation last time where people were going into the downturn 90% LTV, and it doesn't matter how shallow your downturn is. If you're so highly leveraged, you hit any kind of road bump, you're going to have a problem. This time through, there's a lot more equity involved and a lot less debt, and a debt at better levels. So you don't have the same initial conditions. And frankly, just looking at this chart, there's just more liquidity in terms of the number of lenders who are willing to work with you. I don't have this data going back before 2011, sadly, but what we did is we counted up in our database the unique number of loan originators for every property sector. And I indexed it to 100 in 2015 just to kind of make it consistent, because there's a whole lot more loan originators for the apartment market than there are for the hotel market. But what it's showing is that for some sectors like apartments and industrial, there's some ups and downs, but the trend is up in terms of the number of unique groups trying to originate those loans. If you own an apartment building, an industrial building, you've got a lender who's willing to work with you. As opposed to the hotel market, that's one where there is some distress. You have no income coming in for some of those properties, and you've got fewer lenders willing to work with you. Retail and office is kind of in the middle, but it's not a collapse. There's still people underwriting loans, and there's still some debt available, which means that if I'm an owner, I'm not forced to sell if I don't want to take the price that some bottom feeder in the market is offering me. I can afford to wait because I can work with my lender for now. Another form of investment that's been growing is construction. Construction is an investment. It was a bit surprising to me. This is one thing that surprised me a bit about the crisis. We've seen development site sales not really fall off as much as everything else. Developers are kind of looking through the chaos of COVID and understanding that 3 or 4 years from now, when I bring this project through to completion, we'll be back to some sort of normality and I can just deliver this stuff. Although the two sectors that lead on construction in the last 12 months in terms of value of construction put in place were the apartment sector and the industrial sector, which in a sense isn't surprising given that there's debt available for those and prices are doing a bit better. But that issue on prices, this is the last side I've got before we turn it over to get grilled. But this taking a long perspective on prices, I think, is important. Sadly, RCA was only founded in 2000, so our data only goes back that far. I wish we had data from the firm so we could do our CPPI all the way back to the 1950s. I don't think Bob could have started the firm in the 1950s. He wasn't born yet. But I took some earlier data from, some of you here on the call probably remember the trade group National Real Estate Index. I kind of strung some data from a survey of prices that they did onto our CPPI to give us some trends in the 90s. And there's some earlier data from the Federal Reserve Bank on some portfolio values. Took me back to the 1950s. And really, every recession is different. This is I think the key message here. There's two, since 1950 where this price measure fell more than 10% per year. That was the aftermath of the 1990s S&L crisis and the global financial crisis. What they had in common was a contraction in the debt markets. The other recessions we went through, like go back to the 70s, some of those recessions in the 70s, prices actually grew. There was still lending happening. There was still growth in the service sector of the economy. There were different types of economic shocks. So, I think the thought that was out there earlier in the downturn was that prices were going to collapse, that we were going to go through the same kind of calamity as last time. And it just hasn't borne itself out. There were different conditions going into this. You need to think about property differently than you did in the aftermath of the financial crisis. And frankly, I think that at this point, we're through probably some of the worst of it. That's it in terms of the slides I've got. But the one thing I will say is that, since I see a bunch of questions popping up on that, is that, yes, slides are going to be available. We'll make sure that they'll get distributed afterwards.
Thank you very much for that, Jim. Inviting Bob to join. Of course, I was teasing when I said I was going to be tough on you. I can't be. You're too charming of a guy. Jim, you said something that struck me about, maybe this was overblown, this idea that nobody wants to be in cities anymore. And how about, I'm willing to take that point without arguing it. How about downtown core areas versus first ring or suburb? Do you see a shift there? Is that happening or is that not even happening?
There has been, we have started to see a bit of a price decline for offices and CBD locations. It's a bit skewed though. Manhattan is leading that. Manhattan, but again, COVID isn't everything. there were already some changes in Manhattan across property types, before the COVID crisis hit. Again, the hotel sector, 2019, we saw a high-profile default of a hotel construction loan in Times Square, and the market froze for a while because everybody's concerned about what happens next there. You had competition from things like VRBO, Airbnb, lots of new construction, and so people were a little bit hesitant on jumping into that market at those prices. The apartment market was already sliding a bit because of investor reaction to more intensive rent control regulation. But CBD offices, that's the thing that everybody's been looking at, and it gets a lot of analysis well outside of our real estate value kind of circles, because people are asking questions about what happens next in terms of going back to the office and where will we be. That has translated to more uncertainty on those prices. There's more of a gap between what owners are willing to accept in terms of a price and what buyers are willing to pay to kind of jump in and take on those risks. Those spreads between those expectations are so wide. It's a deal volume more than anything. But even with that deal volume down so much, the owners have accepted some price declines, but not huge 10, 20% declines in prices. It's not down that much yet.
Yeah, I'll chip in here for a second. Jim and his team are showing me some numbers, a glimpse of the, first half and second quarter numbers. And, the activity in the office sector has really shifted pretty strongly to suburban secondary markets. And so that is, that would include Dallas. Dallas is the number one investment market. It's the number one development market. Austin, certainly some of the tech markets, but what's also at play, and I think Jim was right to point out that, it's tough to remember what was going on before COVID, and we're attributing a lot of trends just to COVID. But, there was a very strong trend of movement of people from high cost urban areas, and high tax urban areas like New York and California, San Francisco, Chicago, to places like Texas and Florida. And that is, still, a strong trend that's underlying. It makes it looks like it's COVID, people fleeing the cities, when it's still a lot of people just fleeing 15% tax rates in New York City and New York State.
And moving on to places like Dallas. Jim, to use your words again, you referred to alternative asset classes, life science, medical office, data centers, etc., as thin markets. And I hear you. Again, I'm not going to dispute that. Are these alternative asset classes here to stay, or is that just some temporary fun, and eventually big players will all go back to good old office, eventually retail, because there will be some retail at the end of all of this, now industrial, et cetera, or do you think these thin markets have a future and could become something more than thin?
I think you have to look at every one of them individually, and just kind of back into asking yourself, what is the fundamental demand for the property type and what's driving it? And those kind of issues, if you look at every one of them. I was a bit concerned for a bit about student housing because I remembered I was visiting my alma mater, and I saw just all the tremendous investment that had been happening on the campus. And I remembered, when I entered the campus as a Gen Xer, I got in, just by interviewing it and applying anyplace else, and I just got in. It wasn't because I was a brilliant student. It's because I was the lowest population births in the Gen X period. And so they had overinvested in it for all the baby boomers, and they had an extra seat for me. So it was no problem. So I was worried that are they making the same mistake? But I dug into the figures, and no, the population growth of 18 to 24-year-olds. In the economics world, there's all kinds of things that we can predict, and some with certainty, some without. But population growth is probably the easiest, because you count the number of young men, the number of young women, nature takes course, and then you get population growth. And that's easy to track out. And we've got to still, even though we're coming down from the high points in recent years, we don't have a big collapse ahead of us. So we have a very a good run room for that 18 to 24-year-old population. So, that kind of analysis, I think you have to break down for every property type. And some of them, like data centers, it's thin now, but it's growing. But, I think, it's only natural to assume that more and more digital transformation of the economy will need more space to kind of manage all the bits and bytes. So, that's that kind of analysis you have to do for every one of them. But they're all different. There's different unique features for each.
True.
I'll
Bob?
add that, it is a global trend that we're seeing. It's just as strong in Europe and Asia, this movement to alternative sectors, data centers, medical office, student accommodations, all of that is, so it's a global phenomenon. So I think it's probably here to stay. Especially since, retail as an institutional asset class is a lot less desirable, and it had been a big institutional asset class. So investors are, struggling to look for, other areas within commercial real estate to get their allocation.
Thank you. Again, starting from your presentation, Jim, you talked about distress being minimal. See, I'm not that tough a guy, and plus, data was there to show it. It is minimal, so I'm not going to argue that. But is there a chance that government support programs played into that? The fact that nobody had to rush to the exit. I know in Canada there was a lot of government support programs helping a lot of people at very different levels. Was there anything like that in the United States, or not really? And what will happen if there were, and when these programs easily get out of the equations?
Yeah, thinking about Canada versus the United States, I like the way Canada handled some of these issues more. They, provided, direct cash payments to some households, and it was a much easier process in the United States. There's a lot of experimentation that happened there, and some worked better. Now, in terms of the government support, though, the owners, I have a bank and they're willing to work with me, as opposed to in the financial crisis, you had a lot of the borrowing that happened for commercial property before the crisis. Almost 60% of it was CMBS debt. In the CMBS world, in CMBS 1.0, if you ran into trouble, there was no wiggle room. You had to go to the special servicer, and at that point, it's getting into the whole foreclosure process. One client told me they had a property that they had to give up. They probably could have survived if they had a traditional bank lender, and they could have actually gotten somebody on the phone to talk to about, some delays. They could do some CapEx that was needed, but no, so they had to throw the keys back. And that's what's different this time. The bank lenders were the biggest source of debt capital this time through. So there's somebody on the other side of the phone, and the CMBS market is more responsive this time through, though. That has been an important feature. But it's also the case that they have more leeway, and there's less of a problem in that sense. And so nobody's being forced to take a loss because of the government support and the extra liquidity that's put in there. I mean, part of the issue in the financial crisis, it took months of dithering before folks stepped up to realize that, hey, there is a problem. There's a problem that McDonald's may not be able to cover their paychecks because one bank won't cover another bank's checks. That was extreme. This time through, we had the CARES Act come through tremendously quickly. So that did provide a sense of stability. So the credit markets never really got impacted. It did for a few days, but it wasn't months of chaos in the credit markets like we saw in the financial crisis.
So one should not fear that government programs can come to an end and then, oops, we're going to see some reality pop up.
Well, you never know. I mean, I'm not afraid that, just where things are right now, that you're going to see a sudden change and everything ends tomorrow in terms of, the various programs that have kept everything in place. But the market is has been supported by, some of the stuff that's been happening from a little more leeway by the regulators. If suddenly they all decided, hey, let's be tough. Let's make sure every loan is perfect. Let's make sure that we restrict credit availability and make a hard money kind of world. That could lead to some problems for commercial real estate. How likely is that? I'll let someone else put figures on it, but I don't think it's likely.
Well, let's let Bob put a finger on it.
Well, I won't put a figure on it, but I'll tell you what the next step is, let's say the banks toughen up, and they've been incredibly lenient, and kind of expect that to continue because it's been a winning strategy, especially as the market, the economy keeps getting stronger. But even if they didn't, there is a substantial amount of equity capital just looking for them to toughen up and throw some distress out there on the marketplace that they can buy at a discount. And they'll probably be disappointed at the level of discount, but there's tremendous amount of, for lack of a better term, vulture capital that was raised. That's going back to early 90s term, I guess. For distressed situations emerging out of COVID that, has largely been frustrated. So, even if the banks toughen up, there's a big audience of people there to catch it.
Thank you. Jim, again, starting from your presentation, development sites doing okay. Give or take a few of your words. Is it possible that maybe these development sites are doing fine because developers, owners know that new space will be needed once this is all said and done? New looking kind of space, newly shaped kind of space. I don't know what kind of space, but new space. Is that possible? That in expecting that new space will be needed, people are hopping on development sites?
Part of it is the developers are building, number one, to what they expect 3 or 4 years from now. And at that point, the assumption is that, hey, COVID will be gone, which at that point I think is a fair assumption. But also, the lenders are willing to work with them. And if there's a truism in the development world, if a lender will give you money, you'll build. That combination, it makes it possible. But then what they're building is changing. There's much more of a focus on garden apartments in these secondary markets where you don't have local regulations and NIMBY neighbors telling you that you can't build apartments. So that has been an important consideration. And plus, the need for all this logistics space to handle e-commerce traffic. There's been more of a push for new, larger facilities. And that's where some of that development site sales has shifted to. And so if you break down the development site sales to kind of the types of markets, it's been kind of constant throughout the crisis in these secondary markets and these smaller markets scattered throughout the country, as opposed to the expensive coastal markets where the sale development sites before COVID even was on the way down. So it's a bit of a mixed bag in terms of the location. Part of it is these secondary markets where building housing is legal, and that's where you're going to build a warehouse anyway because at just lower land costs. So it's a mix of property types and locations that's driving it.
Thank you. I'm back at a central bank here in Canada. Been back for a year now. So, of course, it's part of my daily routine to hear the word inflation. We get very agitated when we hear that. How about the industry? How does the industry as a whole feel about inflation, particularly when you see the headline grabbers, which is what now? Headline inflation at over 3 in the United States. How is the industry coping / reacting to that, if anything?
Well, I'll take a start here since, and Jim, you can follow up because you're more the economist. But, I'm of the camp that, over long periods of time, inflation benefits real estate. I know it benefits real estate capital flow. So people want to have hard assets. So, the story is even more compelling, and it was already strong, for whether it's private capital or institutional capital to be invested in real estate. And certainly we'd expect, although it's probably a little too early, and Jim, I don't know that we've seen it, a movement to more long-term fixed debt, which is, one of the best strategies if you're expecting inflation. I think it's a little too early for that, but debt continues to be relatively cheap. So, it hasn't driven up the cost of borrowing yet. I think right now, like other investors, real estate investors are, still wondering how much of the inflation is temporary versus permanent. And, certainly we've seen, inflation in construction inputs and driving up the cost of, construction, immensely. And that helps buoy prices of, existing properties as well. So, I'm more focused on, I guess, the positive impacts of inflation. And we haven't really seen the negative impacts yet, which was, higher interest rates. So Jim, that's my real estate blinder capital.
What's funny, that distinction between the capital raise, I've seen your story, Bob, of people trying to raise money and talking about the fact that, hey, we may have an inflationary situation underway. That's a good reason to be in real estate now. And you have a hard asset, you'll be protected to the extent there's some unexpected upsides on that. But yet still haven't seen a move towards the long-term fixed rate debt. So so you say one thing and you do something else to some extent. But I think in the short term, the other issue is that the question that people have been jumping on is is the inflation temporary, just transitory as the economy restarts, like the inflation spike we saw after the Korean War, or is it more of a permanent shift? One thing that is going to drive it to be a little bit lingering is the fact that the housing component is built in kind of a funky way. It's not like the spot market rents for apartments. It's a lag. It's like a 3-year lag of existing leases that don't always roll over. And so it takes a while for inflation in the housing component to come in. And that's still been underperforming. Prices are going up, rents are starting to climb again. That's going to get into the inflation figures, but it's going to take a couple of years before it really starts to come in. So we might be dealing with a little bit higher inflation for short term, just because of how it's constructed as that housing component comes in. So there's going to be, I think, personally, I'm looking a little bit more at some of the alternative inflation measures just to deal with that housing component, because I don't think it's realistic looking at it in the sense of just that lagged impact of leases over the last 3 years. What's the spot market rent? How is that changing? I think that's an important thing to consider.
Thank you. Anything to worry about with respect to potential changes to the tax regime? You already alluded, Jim, to the fact that even prior to COVID, it was starting to happen. Some people were moving away for tax reasons. Anything currently underway or currently being discussed, or anything out there that can make people or the industry nervous?
A lot. What is the administration has proposed, which is substantially higher capital gains tax, the elimination of 1031, are certainly and stepped up basis, upon death, which is for private investors, real estate's been one of the best ways to transfer wealth between generations. So it have profound impact, particularly the elimination of 1031. If that happens, it's certainly being discussed. And it's been discussed in the past. And I think there's some really good, valid arguments once people get into it, and why 1031 is actually a good thing. But, higher capital gains is certainly going to, have an impact for the big equity funds if they eliminate the carried interest. The real estate lobby was, heavily for that. That is something. So, I think we can expect higher tax environment. The question is when and how much. It's certainly probably not going to be anywhere close to what's been proposed, but it's going to be above where we are right now. But I think that we'll see, particularly, if there's a hard and fast date, a lot of selling activity, positioning right, before any higher capital gains takes effect. If we, have a little better idea when that's going to happen, and if it's not retroactive. So something definitely to keep our eyes on, and something I'm worried about that could disrupt the market.
All right, thanks. We are almost out of time before we pass the microphone on to Michel, who's going to take questions from the audience. But we must play a game I like calling Ruining Your Reputation with Mario. And here it is. Very easy question. Before the pandemic hit, I know in Canada the figures was something like people working on average half a day per week from home. I don't know what was the figure in the United States. I should have looked, but I don't know. But it must be something around that. How much will it be once this is all said and done? Are we going back to half a day a week, or nope? Going to a day, 2 days a week, 3 days a week? What's your take on that one? Because it has serious implications.
Yeah. I'll just give my quick answer is I think we're going to go to 3 days a week over the near term. And then if you ask me like 3 years out, we'll probably be closer to 2 days a week working from home.
Okay. But still 2 days, which is almost half the time, which does not necessarily mean people will need half their space, but it could have an impact on office space demand. Jim?
I think it's a tricky issue, because I think you have to slice up the labor force into different profiles in terms of the economic activity that the workers are doing, combined with the demographic profiles of the workers. If I am a 20-something analyst trying to build my career, I am going to want to be more in a city type location for a couple reasons of demographics and a couple reasons work. Demographic wise, young people, drawn like moths will flock into the city. They want to be around all the other young folks, cruising for the action. You can't get a date living in your parents' basement. But then, when you are, in one of these, cities with the other young folks, you're living in a tiny little studio. Who the heck wants to work there? So you want to be in the office, because you want your employer kind of covering that space. It's a different thing for someone in their early 30s who has settled down. They've started having kids. They're moving to the suburbs. It's a different lifestyle choice for them. And the notion of kind of commuting into a dense area, you may have to pull them in. As a firm, you may have to pull them in so that they can mentor those younger folks. So, I think there's a lot of analysis where people are making some assumptions that there is a office worker and the whole component of office work goes one direction or the other. If you see a guy like Barry Sternlick, working out of a South Florida location because, he's got a nice house there and it's tax-free for the state, that doesn't mean every worker can do that or would prefer to do that. So I think, every industry, you have to kind of slice it up and look at, how the labor force in terms of economic activity versus the demographic components work. And I don't think you're going to get a consistent answer for each one of them.
Given this kind of answer, Jim, are you entertaining any career in politics or no? And being the moderator, I don't have to answer. I ask questions. So without any further ado, thank you very much, Jim, Bob. But we're not done. Here we go with questions from the audience. Michel, what are you seeing from the counselors?
All right, I have a question here, either Jim or Bob. So do you see a significant distinction between the future of destination leisure hotels and business-oriented lodging properties? For instance, New York City is 79% leisure hotels. How do you see these respective sectors playing out in the long term?
Jim, you want to go?
People have to get together. I am looking forward to our first counselors conference together in person.
Absolutely.
I in October I'm going to the ULI conference, the PREA conference. I'm vaccinated. I'm traveling. I'm looking forward to seeing everybody in person again. I suspect that we will get back to those. In fact, I think there's an argument to be made if you believe that office work changes forever and that people are only getting together in the office 2 to 3 days a week. I think that creates more of a demand for conference type hotels in the future, for folks kind of jetting in for a day or two of meetings before they head back to their shack up on the side of a mountain in Banff. That kind of remote work would create more of a demand for hotels. But I think that I think it will come back in the long term, just from the same sense of conventioneering is something that helps grease the wheels for the industry, because there's some things you could do over Zoom talking, but when you're talking to someone sitting at a bar at a mortgage bankers conference, for instance, you're getting more sense on pricing than you will over an email.
I have another one here. I've seen anecdotal stories that New York City multifamily prices, rentals, and sales are increasing, which seems counter to the notion that residents are fleeing the city. Is that true? And if so, what is responsible for price increase in metro multifamily?
Well, I'll start out real quickly, just because I have a little experience there. But rents have rebounded really quickly, and they had fallen. I mean, people were offering 2, even 3 months free rent on a 13-month deal, and started paying the brokerage fees, which is almost sacrilegious for New York City. But that's all swapped around quite quickly, and New York City apartment prices were in a correction before COVID. It was, I guess, a year and a half before they changed some of the stabilization laws, which were that became even more onerous, and overbuilding was a little bit of a threat there too, particularly in Brooklyn in some areas, but which Jim knows well. So it was already in a correction. So the fact that they're going up now is not surprising to me, because it really has firmed up quite a bit.
Yeah, I have Jim.
That notion that everybody's fleeing the cities, it's there's again a lot of different slices of the demographics of a city, and there's different components that changed. We were due to see a lot of folks start to leave in that millennial generation. They're in their 30s, they've started pairing off, having kids. They were going to move to the suburbs anyway at some point. That got accelerated by the crisis. So these suburban markets where there's tremendous demand for housing, all of a sudden, that's there. It's like you're taking a few years of demand and compressing it into one period of time. So that was a bit of a temporary move. There were other folks that left the city as well, but the Gen Zs there, I think it's temporary. Again, living at your parents, you save some money, but it's not fun. And I think that unencumbered by data, I think that those folks are going to be moving back into the city, and that's driving a bit of that rebound in the city. It's I get out and about in New York myself a lot, and over the last few months, Soho has become almost too crowded, and I think that you've got some changes there. The thought that everybody's leaving these areas because taxes are high. At the high end of the income distribution, yeah, there's some folks who certainly are taking advantage of that, but it's not something that everyone's going through.
This is quite a pointed here question, but what will be the impact of the federal zoning initiatives in the suburbs? You want to try that one, Jim?
There's zoning in the United States. It's very much a local thing. You can't change at a federal level everything in the local cities. There are some countries that do that. Japan has one standard across the country. Tokyo, as a result, apartment rents are half that of New York's because they do not make it illegal to build apartments. Big parts of New York, and San Francisco, you should be able to build apartments near transit and everything. I was just in Boston, and I was in Somerville, Massachusetts, where they're building a new extension of the subway system. And in Somerville, they're trying to downzone the area along the subway because they think it will create a more pleasing environment, but it will increase the cost and it'll drive people away. Cities that have made it easy for developers to build what the market wants. There's a great study that the Manhattan Institute put out on that last week. Places like Raleigh, have seen tremendous job growth and tremendous housing growth, a great balance of jobs and housing created. San Francisco, for instance, for every 3 jobs that were created in the last boom, in the tech boom, they created one housing unit. And that's the challenge of those cities. You don't solve it though at the federal level. Part of it is just getting rid of the NIMBYs in every city and letting the property markets work as they will. But there's only so much you can really do at the federal level to initiate that. It's a hard-fought battle, in the trenches, working with zoning boards in every city, and to allow people to build what the market wants and allow them to the right to enjoy the private property that they own to build what the market wants.
Another question: what 2 or 3 property types or property sectors would you say are the biggest winners from the COVID crisis? I think you touched that a little bit, Jim, in your presentation there.
Everybody loves industrial now, right?
Yep.
It's data centers, life sciences; those are components of it.
Yep.
The housing, single-family housing,
Definitely.
has taken off as an investment class, because when you have all these millennials at once sitting in their 30s and pairing off and having kids and looking to move to the suburbs, a limited supply, it drives up activity in those areas. That's clearly the case.
I have one question here, more of a global question for you, Bob, probably here. First of all, thank you to both of you for your presentations. Any thoughts on London in the UK and its recovery post-COVID and then post-Brexit, really?
Yeah. So, again, look at what was going on before COVID. It's tough to remember, but it was post-Brexit. But London and the UK are getting rid of all their restrictions, I think this weekend. I'm bullish about London. It's tough to tell right now because, everything's been such a lockdown. And I think that's really muted some of the post-Brexit, issues of mobility and jobs. But, London, like New York City, my theory used to be, it's probably not as strong anymore, but, commercial real estate prices were set in central London and Midtown Manhattan. Because they were the dominant and most liquid markets. I think they're probably now more like a half a dozen or more markets that, kind of are the price setters. And, probably San Francisco would be thrown in there. And, some of the Asian markets as well, and Frankfurt probably. I remain bullish on London, but it's still yet to be seen, over there. But, one thing that we did see, and we were seeing before COVID, was, even some of the big name investors, institutional investors and sovereign wealth funds had slowed their investment or weren't buying in London anymore, and some had even become sellers. There was a whole rung of capital that had been, squeezed out of or foreclosed out of buying in London for years, because all the big, players wanted to be there. And
Right.
so that capital really rushed in. So again, there was kind of a layer of capital that came in and kept prices from falling too much. We saw a little bit of a decline, and then it started moving up again. So, there's a tremendous demand for assets in London. So, I certainly don't expect much of a repricing.
Right. Another one, Bob, as compared to domestic investors, have foreign investors changed their U.S. markets or property types they are targeting today versus pre-COVID?
No, Bob.
Yeah, why don't you do that? Because Jim, you just put together a report exactly.
Sure. Go ahead,
Yeah.
Jim. Sorry about that.
No worries. The funny thing about the cross-border investors, a lot of folks, myself included, I thought that, that might fall a little bit more than other types of investors during the downturn.
Right.
Just because, if you're stuck on your couch, it's hard to get deals done. And if I can't cross borders, it's hard to get deals done. But, cross-border money can cross borders. Money is not an issue. And these firms had people, pre-positioned in the countries. If you're a GAW capital, sure, you're based in Hong Kong, but you've got a big operation in Orange County that can do deals throughout the United States. If you're Brookfield, you've got people all around the world. So, the money flows, and the cross-border money as a share of total was constant through the downturn. Now, it did shift a little bit in terms of what it was focused on, like everybody else, more focus than the past on logistics properties. Everybody likes that predictable yield that's coming from it. The cross-border money was a little bit more focused on offices than domestic money, throughout the downturn. But it always has been. For if I'm a fund manager from the Middle East, I'm coming to the United States, I'm not spending $2 million at a time on a deal. It's just not worth my time to do that. I'm not going to hop on a plane unless I can legitimately spend $50 million at a pop just to be able to put that capital to work. And large office towers do fit that bill to some degree in terms of the efficiency of deploying a lot of capital at once. So they've been a little bit more focused on offices. Some of the fears over offices and where do they end up. There's been a little bit less of that in that crowd.
I think, Mario, do you have a question before we break? Before we end we could do this for another hour easily.
Well, of course. I started the game and we didn't go far into it, and I can continue with the game called Ruining Your Reputation with Mario.
Mario.
Now we're looking at industrial logistics, and I, for one, but you guys have way more experience than me. Not in terms of age, of course, experience in real estate. But I'm looking at industrial logistics, and I just can't believe the kind of price we're seeing now and the kind of cap rates. And has that gone too far, you think? Or no, it's just, as you very well said it, Jim, throughout, it's all a question of supply and demand. And but I cannot help but feel like maybe, just maybe, it has gone a little far.
It's Jim and his team are about to put out a report that basically the top industrial assets are selling at yields equivalent or better than trophy office buildings.
I know.
It seems like a bit much, and overall the average cap rates in the industrial sector are about to fall below the office sector. So it's a wise question, but I'll turn it over to Jim to let him ruin his reputation.
Well, I was thinking about the game ruining your reputation with Mario is probably something more appropriate for like a Habs Bruins game. But the industrial sector, we're building a lot of space. It's a record level of construction. Investors are responding to demand by delivering space. I think there's an ongoing need for this industrial space just to handle all the e-commerce and the shift in how businesses are operating in terms of how they're managing their inventory. I think some people are getting a little too excited about that. At the same time, you see the e-commerce sales, and it's been growing at an exponential rate. And I've seen some presentations where people just kind of take that and do an Excel form fit and just sort of not think about the underlying goods that are being sold, but they just look at the headline numbers and they assume that it grows, that it continues to grow at an exponential rate. I think some of those folks might be sorry about, their expectations, but it will be a while before it comes through. I mean, I think we got a good 10-year run road of ongoing growth in e-commerce activity above retail sales in general. So I think folks are really focused on that. But the challenge gets into when it starts to slow, we'll probably overshoot at that point. But I don't think that's in the near term.
Yeah, one thing I'll add that I don't think it's near term either is all the supply chain issues that we've been having for a myriad of goods. You can bet a lot of companies are thinking about having more office space, to hedge against that in the future. That the supply channels aren't as efficient as they thought, and they need more warehouse to hold goods.
Michel, in theory, we're done. Do I have time for one last, or we're done?
Go quickly, Mario.
Okay, one last. We just played the office game. Well, the teleworking, now the industrial logistics, retail. I know it's vague, but where does it go from here?
Only up.
So the slide is done.
I got to tell you, I think that, retail's always been creative destruction, throughout my whole career, and certainly is a long-term declining trend. And, you can argue that we had way too much retail space per capita, and you just look at the stats compared to the rest of the world. So, that's coming back into line. But it doesn't mean you should redline all retail.
Yeah, and if you segment retail, the stuff tied to daily needs, the triple net stuff, that's more stable. Where retail gets a bad name is, everybody's assumed that retail is a regional mall in Ohio built in the 1960s, for manufacturing workers to buy their polyester pants. It's a different thing in every city and different conditions. But I think some of those older assets, it's also an opportunity to redevelop. I mean, someone's taking a loss when you do that, but some of these retail facilities, the huge parking lots that can be repurposed to denser uses of housing and mixed purposes of offices, medical activity, logistics in some cases. Just what you really need is city leadership in the cities where these old malls exist that are willing to work with developers to come up with, the best plan of what the market will bear.
That's a good point.
Thank you.
Thank you, gentlemen. Well, thank you so much, Bob, Jim, Mario. And I trust our viewers will agree this has been one of the finest hours of real estate dialogue in recent memories. And we're privileged to have been part of it, all of us, the counselors and beyond. We're grateful for your willingness to go beyond the numbers and address the question on many of our minds during this unusual yet opportunistic time in our industry. On-demand recordings are available for most What's Next sessions, including today's, and watch for details on our fall programming coming soon. Until then, on behalf of the Counselors of Real Estate, thank you for attending this session of What's Next for Real Estate and Life Experience. Be well, everyone. Thank you.
Thank you.
Thank
Thank
you.
you all.
Thank you, counselors.